Some people are not actually emotionally or psychologically fit to own stocks, but I think more of them would be if you get educated on what you're really buying, which is part of a business.
If there's one book that you need to read to become a better investor, it's this one. The book was written by Marie Buffett, who was married to Warren Buffett's son, and the book clearly outlines Warren Buffett's strategies in a way that will appeal to newcomers and seasoned Buffettologists alike. The book is inspired by the seminal work of Buffett's mentor, Benjamin Graham, who also wrote The Intelligent Investor. And this book presents Buffett's interpretation of financial statements with anecdotes and quotes from the master investor himself. This book really helped me to up my investing game, and in this video I'm going to show you guys a document that I created to help you to become a better investor. There's a few fundamental things that you really do need to understand before you can start investing your hard-earned money. Charlie Munger, who is Warren Buffett's right-hand man, says it best.
We have to deal in things that we're capable of understanding, and then once we're over that filter, we have to have a business with some intrinsic characteristics that give it a durable competitive advantage. And then, of course, we would vastly prefer a management in place with a lot of integrity and talent. And finally, no matter how wonderful it is, it's not worth an infinite price. So we have to have a price that makes sense and gives a margin of safety considering the natural vicissitudes of life. That's a very simple set of ideas. And the reason that our ideas have not spread faster is they're too simple.
The Warren Buffett and Charlie Munger approach will really help you to understand investing much better. Because you are basically investing in a business, you need these 4 pillars to become a successful investor. Personally, I really like the approach that Warren Buffett and Charlie Munger follows, although this is not the exact strategy that I use, because everyone or every investor's strategy will be a bit different depending on your age and your risk appetite as well as your knowledge. My approach to investing starts with a 2-step process. The first step is knowing whether a business or a company is a good investment or not. This is basically where you look at a company's balance sheet, whether they have a good financial position, do they have enough income to pay their current liabilities, do they have more cash than current liabilities, do they generate enough free cash flow, does the company have retained earnings, are they doing share buybacks, etc. This is the fundamental part of analyzing a company. This is very important, and it's always important to spend a lot of time here. And in this video, I'll share a document that will help make this process much easier. Then, of course, the second part of the process is figuring out at what price you should buy that specific company. I'm going to be honest, this is probably the more difficult part of investing because unfortunately, it's not as easy to predict what a share price will be at a certain time, but we can use certain tools and websites to make the most accurate guess possible. This is where we use certain valuation models such as the 2-stage discounted cash flow model, and although this is more an art than anything else, this is something that a lot of new beginner investors struggle with. I made a video where I talk about the discounted cash flow, but I'll show you guys a much easier way to do this, and hopefully this can improve your skills as well. With that said, I'm going to jump to my screen and share a few things, and hopefully you guys can follow along. You are welcome to download this sheet if you are part of my lowest tier members. So the sheet that I created looks something like this, and although there's a lot of information at first, it's really quite simple to kind of complete. I'm going to show you guys how you actually use it and why it really makes investing much easier. So we have information that we will be using from an income statement, a balance sheet, as well as the cash flow statement. This is information that you need to go and find, whether it's on the actual annual financial statements or whether it's on Yahoo Finance or Stock Unlock or whatever it might be. So at the bottom, we'll see there's a tab that says data, and this is the physical data that we will be entering. What I've done is I created everything and I highlighted where it is located, meaning that our income statement is yellow. So all the information that is yellow will be found on an income statement, and I obviously put it in brackets next to that specific data entry. So what I'm going to do is I'm going to enter a few of them. I'm just going to jump to Stock Unlock, and I am going to type in the stock that we are going to use today, which is Occidental Petroleum Corporation, or however you pronounce that. This is obviously a stock that Warren Buffett bought quite a while ago, and he keeps on adding to this company. I'm going to jump to the financials tab, going back to our income statement, and then I'll scroll down. So back to our Excel sheet, we can see that the first data that we need to enter is SG&A, which basically stands for Selling, General and Administrative Expenses. So we can click on the yearly tab, which means that it's all the expenses that was accumulated within a yearly period. I'm going to go to Selling, General and Administrative Expenses, which is $2.727 billion, and I'm going to go to my sheet and I am going to enter it here, 2.272 billion. Next, I'm going to go to the second one, which is research and development. Here we can see research and development is 216 million. What we're going to do is we're going to enter 216 million over here. We're going to skip the depreciation because this is located at the statement of cash flow. Next, we are going to jump to our pre-tax income, and on Stock Unlock, it shows income before tax, which is 2.903 billion. I'm just quickly going to go and complete the rest of the data. So I've entered all of the relevant information, and what the sheet basically does is calculate a certain ratio. At the beginning, at the income statement, it basically divides the SG&A through gross profit times 100, which then gives you a certain percentage. In this case, it's 41.6%. Again, the next one is research and development divided by gross profit times 100, which gives you another percent. This is followed by depreciations divided gross profit, which is basically certain income statement ratios, which is used to determine whether a company is actually performing good or not. If a company has a lot of research and development cost, it means that it takes a lot of money for the company to keep growing its revenue and to improve its product or service lines. Again, if a company has a lot of SG&A cost, that means that it is taking majority of the company's profit to generate revenue. This again isn't necessarily a good thing. On the right hand side, I've created a tab which shows you whether it is good or poor, meaning if the SG&A divided by gross profit is under 30%, it will show that it is a good indication. Vice versa, if it's above 30%, it means that it's poor. Next, we can use debt to shareholder equity, which is your total liabilities divided by your shareholder equity. This should be below 1 or 0.8. In this case, it's 1.29, which indicates that it is poor. What I've done is we combine and use an average of your goods and your poor to show what the recommended buy or sell for this specific company would be. And in this case, we can see that it shows a percentage of 61 for good results and 39% for poor results. This kind of shows that the company is between the middle. It's not necessarily a massively profitable company at the moment, although things can definitely change in the future. The purpose of this sheet is to make it much easier for yourself to figure out whether a company has good margins. Certain stuff like operating cash flow divided by revenue, which is your operating cash flow ratio. If this is above 20%, it means that it is good. This is a very good indication that the company is generating cash flow from their operations. We have other metrics to use as well, like finding out if a company has share buyback programs. In this case, it is yes. So if you can confirm that, it's obviously a good indication. And I really do want you guys to play around with the sheet so that you can understand what to look for. Certain stuff like gross profit, if we look at the gross profit divided by revenue, if this is not above 60%, it means that the company isn't necessarily creating a lot of shareholder value. This gross profit is 58%, which is pretty close to 60, but still it will show that it is poor, although it's obviously not that bad. This is just something that you need to take into consideration, because with the Excel sheet you need to kind of set a boundary to determine whether it's good or not. All of these suggestions that we see here was found within the book that I just show you guys, and I feel that it's a pretty good indication to start with. Obviously, with every company it will be different, and this is by no means the only analysis that you need to do to determine whether a company is a good investment or not. What I'm going to do is, this is our first step that we completed, or part of our first step, which is our fundamental analysis part. We can obviously study annual financial statements, and we need to understand the physical company. Our next step would be to determine whether it's trading at a discount or not. And there's one or two simple ways that we can do this. And what I'm going to use is stock on lock. What I'm going to do is I'm going to use Google or Alphabet in this cash flow model. And again, just really understand that the numbers that I'm using here is just a indication, or let's say a educated guess. We're going to use the metric of free cash flow. I clicked on the autofill tab, so it automatically entered numbers for this specific company. I'm going to change a few things, and we're going to click on the number of years. So we're going to use 10 years to project the metric growth rate. We can use averages. A good way to get to these metric growth rates is to use platforms like Yahoo. We can click on the company that you want to search for. We can search for the company, let's say Google over here. Then we can go to our analysis tab. We can scroll down and we can look at the current year's growth. Here we can see 10%, and for the simplicity of the video I am just going to use 10% over here. And then it has shares outstanding growth of 0.2. This is actually accurate, and the price ratio would be the price that we will be selling the company at in, let's say, 10 years. The discount rate would be the return that you expect over the term of the projection. Again, if you change this will obviously change the numbers quite a bit. And what this shows is that the stock price is currently trading at $108, and it shows that the fair value of the company is around $129. Here it shows the projection of the company over the coming 10 years. And this is what we use to determine whether a company is actually trading at a undervalued price, or if it's actually fair valued or overvalued. This is by no means a set in stone, because if we change the numbers, it changes the calculations quite a bit. Let's use a metric growth rate of 11%, and we can see that the fair value changes to $141. This is a great tool to use to play around with. It's much more user friendly. Another platform that I use, and I kind of use both to cross check each other, is Simply Wall Street. I really like the platform, and it shares quite a lot of information. There's really a lot of valuable stuff that you can kind of go through over here. But what I want to show you guys today is the share price versus the fair value price. And this is again whether the company is overvalued or undervalued. We can see the current price of $108, where it shows the fair value is around $143. If we click on data, I just want to show you guys the model that this company used, and it is called a two-stage discounted cash flow model. So it's a bit more intricate than the one that I used on my Excel sheet, as well as the one on Stock on Lock. But with that said, we can see that the company is currently undervalued at 24.3%. If we go back to Stock on Lock, we can see that it has a fair value of 141%, which is really quite close. So we can play around with these numbers a bit to see if we can get an accurate match, and we can use the information that was used on both platforms to determine the best guess that we can make. This is just one part of the valuation that we need to understand when looking at companies. I am going to share all the platforms that I used, which is basically Yahoo Finance, Morning Morningstar, Stock Unlock, and Simply Wall Street. And it's really good to use a combination of tools to determine certain aspects of investing instead of just trusting everything using one specific tool or evaluation method. With that said, the idea of this video is to show you guys my approach, obviously using the fundamental tips that Warren Buffett and Charlie Munger uses. I created the two-step approach, which is analyzing the company, whether it's a good investment, with balance sheet, income statement, doing the actual fundamental analysis. The second part is doing the valuation, meaning whether it's trading at a fair value or if it's undervalued or overvalued. This is very important because we can buy a good company which passed our first step, but we are going to overpay for that company, which means that our return over the coming years won't necessarily be as good as it could have been if we bought it at a lower price. That's where the margin of safety comes in. So that's part of the discount rate that we used in Stock Unlock. And the higher your discount rate, the lower you need to buy the company at. So 10 or 15% is usually a good indication to start with. So I really do hope that this can help you in some way. If you found this video valuable, definitely give it a thumbs up. Leave a comment down below. Let me know what you think. And I really do hope to see you guys in the next video. Thank you so much for all your support and all the positive comments. I really appreciate each and every one of my subscribers. With that said, I hope you enjoy the long weekend.